Well, welcome everyone. I'm Louis Ederington, and some time ago, Lisa and I and some of our colleagues began some bond market event studies using the TRACE data. And the questions and issues and problems we ran into led us to do a methods paper. And I thought it might be helpful for those of you who are doing bond market event studies, are contemplating bond market event studies, if we went over some of the issues and problems from our experience that you're likely to face, and provide you with some of our suggested procedures for solving or at least mitigating these problems. Got my clicker. Right. As you know, the number of stock market event studies is legion, but historically there's been a much smaller number for the bond market. And I think that part of the reason for this has been that until recent years, there wasn't very good data. Most researchers relied on either quotes from the New York Stock Exchange's bond market, which is a small, primarily odd lot market accounting for only a tiny percentage of trades, or they had monthly observations from Moody's or Standard & Poor's or Lehman Brothers. But in recent years, a number of daily databases have become available, and these include the Merchant FISD database, which has trades by insurance companies, dealer quotes from DataStream, and in particular the TRACE database, which since 2005 has covered comprehensively almost all corporate bond over-the-counter trades. Right? And that's what we're going to focus on here. As I say, this data makes it possible to do the short-run bond event studies similar to those that we've done in the stock market. I think these are most interesting when we have either one of the two situations. One in which the interest of stockholders and bondholders diverge, is illustrated by my example here on the dividend increase. And another would be situations in which we have several theories explaining why the stock market moves in a certain direction, but these theories have different implications for the bond market, as illustrated by this second one here. Right? But when you're doing bond market event studies, there are a number of issues which are either not present in the stock market data or are much less serious there. So the techniques that we've all learned for doing stock market event studies don't translate to this market very well at all. And here are the ones that I think are the most important. There are a number of them. But one is that when you're doing a bond market event study, you're probably not going to do it in isolation. You may be running both a bond market and a stock market event study, or you may be relating how the bond market reaction relates to some firm characteristic. Right, so it's necessary to match the bond data from TRACE with your data from CRSP and our COMPUSTAT. And that's, as we're going to see, is not as straightforward as it may appear. Another aspect is that, as you all know, bonds differ by on a number of characteristics, including maturity or duration and rating. And a 2-year AA rated note is going to be much less volatile than a 20-year B-rated bond. Right? So there are two aspects to this. One is calculating abnormal bond returns. Right? We propose, and we're not the first, to use as the benchmark for calculating abnormal returns the returns on bonds of the same rating and similar maturity over the same period. But even after you do that, right, those abnormal returns are going to be much more volatile for longer-term, low-rated bonds than they are for high-rated, short-term notes. Right? So we're going to argue that it's important to adjust for this by standardizing. Another issue that John and I were just talking about is that bonds are very thinly traded. Right? On the average day, more bonds do not trade than trade. Right? And to calculate a return, we've got to have observations on 2 days. So that so the problem is exacerbated there. A final one is that a number of firms have more than one bond outstanding. So issues arise in how do we combine the abnormal returns for individual bonds into a single firm bond return. Right? Another thing that I might mention is that bid-ask bounce in this market is relatively large versus the stock market. And there are two aspects of this. One is that the spreads are fairly large, like $2 per $100 par value on average. And the other is that the underlying returns are smaller for bonds than they are for stocks. So jumping from trades at the bid to trades at the ask creates quite a bit of noise, and that's going to go together with this thin trading issue. So let's start looking at some of these issues, and we're going to start with the issue of matching the bond data from TRACE to data from CRSP and COMPUSTAT. And at this point, I'm going to turn it over to Lisa, who's been the one in charge of doing this, and then I'll come back to talk about bond event study methods. So, Lisa.
Thank you, Bob, for giving me this go time one. So we're going to look at how to match bond data to firm, and especially stock data. The first step would to merge the TRACE with FISD. It is because TRACE reports information on bond trades, such as transaction prices and volumes, but have very limited information on bond characteristics. So in order to get bond characteristics such as coupon, maturity, rating, covenants, etc., we have to merge it with FISD. It is merchant data set. And within the fixed income data set, we can simply use the issue QZIP, which is 9 digits, and in FISD, and QZIP ID in TRACE to match bonds between the two data sets. So these are simple. And the good thing for FISD is that it provides issuer-specific informations, such as name, single tickers, and industry, so that we can use the more characteristics on the issuers to link with other database. Now, we have two challenges when we match bonds with its firm and stocks. First, many firms have more than one bond. Matching bonds with their issuing companies can be complicated by the fact that bonds of one firm can have different identifiers and names within the fixed income data sets. This is because when if a firm changes name or reorganizes, the bonds may continue to trade the original prospectus name and identifier. And second, if a merger and acquisition occurred, then the bonds may continue to trade the under the old name. And the third, bond issued by a subsidiary may be guaranteed by its parent, but the bond is traded under the name of the subsidiary, which is not a public firm. So another challenge is that for most users, it is necessary to match bonds with stock data like CRSP and accounting information in COMPUSTAT. So we have to match the fixed income data set with other databases, and these are challenged by that the different identifiers used in these different databases. So let's look at these identifiers in these major databases. This is our FISD and TRACE database. The unique identifier for firm is issuer ID. And each issuer ID may have several issue ID, and this issue ID is at the bond level. And the fixed income data have a second ID for firm is the issuer CUSIP, which is 6-digit CUSIP, but it is historical CUSIP, which means that it can change over time due to the key developments we have just mentioned before. Now, in the CRSP, the unique identifier for firm is perm cum, and each perm cum may have several perm number because of they may have multiple classes of shares outstanding. And in the CRSP data set, we have both the NCUSIP and the CUSIP. This CUSIP is the header CUSIP, which is the last CUSIP belonging to each firm. And the NCUSIP actually is the historic CUSIP here. So basically, if we want to match the fixed income data with CRSP, we will focus on the CUSIP and NCUSIP. And in the COMPUSTAT, we have GVK as the firm's identifier and the header CUSIP for its secondary identifier. So we're going to give concrete examples for how to match bonds with firms and stocks. Look at this example. We have two bonds that have different issuer CUSIP from the FISD. And if we use the CUSIP here to match with the CRSP, we can get a perm non and perm cum number here. This is American Corporation Delaware, and they have another bond which is under the other CUSIP number. However, this CUSIP number cannot be matched with anything in CRSP. But if we look at this is the issuer ID from the FISD, we know that basically these two bonds belong to the same firm. So even though this bond cannot be matched with anything in the CRSP, we'll apply this perm number into this bond. This is the first example that we use the issuer ID to identify bonds of the same firm. The second one is that we want to use the legal name provided by the FISD. Look at this example. We find that the prospective issuer name of these two firms are different. Issuer IDs are also different. And issuer CUSIP totally different. So we might think that the two bonds are different bonds, it belongs to different firms. But actually, we find that the legal names from the FISD that they are the same. And a manual checking from the website is that this diagonal was formed in 1997 from the merger of Grants and Grand Metro. And so the Grand Metro, there's defunct. So this bonds of the firm defunct, but now the diagonal is now responsible for both. So we treat both bonds as diagonals. So we will apply the perm cum from the diagonal for this Grand Metro. Next is another example which shows that we find that the CUSIP issuer numbers are different. CUSIP issuer IDs and FISDs are different. Prospective issuer names are different. But when we use the CUSIP here to match with CRSP, we will find that they have the same perm con and perm number. So basically, these two bonds belong to the same firm, which is the Dell Computer Corporation. It is because that Dell Computer changed its name in 2003, so that the FISD didn't catch that, and we cannot track within the FISD. Okay, we have done the CUSIP and the legal number. Then another procedure to supplement our matching is by using the ticker. Here we can see that the issuer CUSIP are different, issuer IDs are different, prospective issuer names look similar but different, but they have the same ticker. And actually, they are the same firm because in 2000, the firms merged together. And we would like to use the perm number by this firm to the second bonds. However, there's a caution. The ticker symbol can be reused for different firms. So if you are using ticker to match different bonds and firms, you have to manually verify that the matching is correct. The final stage is that after doing all the non-manual checking or CUSIP matching, we have to find that sometimes when matching with the NCUSIP and perm norm in CRSP, but sometimes it is not within the data range of effective of the historical name in the CRSP. And second, sometimes a firm was acquired by a public firm at a later time than its assurance, but not captured by FISD. So I will show you an example that exhibits the two problems in one case. Let's see this company. It is the Datacom Incorporation. When we use the issuer CUSIP of this issuer CUSIP to match with the CRSP, we find that it got a perm con number. However, the effective date range is from 1997 to 1996. However, we got the offering date for that bond was 2010. So it was not right. Then we have to do some manual checking with the Capital IQ. We found that actually Deltacom was the public firm with the NCUSIP of this 45 and increased for the date range of 1997 to 2006. However, when the bond was issued in 2010, the Delcom shareholder was the private equity investors. So Delcom by then was the private firm. However, on October 1st, 2010, Deltacom and Earthlink announced an announcement for the Earthlink to acquire Deltacom. So now the Deltacom is a public firm, a subsidiary of a public firm. So we have to attribute this bond of Deltacom to Earthlink, which have a very different perm con as the original. We find that. So after the October of 2010. So the main takeover is that you have to verify that the matching firms with bonds should be correct in terms of effective data range and all. Thank you.
Lisa is not in the job market this year, but probably will be next year. So, you might want to write her name down. That's Lisa Yang, Lisayeng. Okay. Let me make clear that these slides will be available on the FMA website, so you don't have to have written all that down. Okay, I'd like to now switch and talk about bond event study methods once you've gotten all the data straight here. And the seminal paper, which if you're not already familiar with, you need to become familiar with in this area, is a 2009 RFS paper by Bessenbinder, Callie, Maxwell, and Chu. And they find a number of things. One is they find that event studies using the trace data are considerably more powerful than the event studies using the Lehman Brothers monthly database. Another, and certainly one we agree with, is they recommend calculating abnormal bond returns by subtracting from the raw bond return the return on a portfolio of bonds of the same rating and similar maturity over the same period. Right? They also recommend combining individual bond returns into a single firm bond returns. Now, a few studies have used individual bond returns as individual observations. So one aspect of this is that large firms get many more observations than small firms and dominate the sample. But more seriously, returns on bonds of the same firm are going to be highly correlated, whereas the tests assume that they're independent. So the standard errors, if you use individual bond observations and have more than one bond per firm, are going to be biased. They find that the sign and sign rank tests are considerably more powerful than the t-tests, and we'll talk about that a little more. They recommend calculating bond returns using an average of all the transactions on a day, weighting each transaction price by trade size. And in doing this, they recommend eliminating or throwing out the very small trades, which account for a large number of trades on trace. They recommend throwing out trades of less than 100 bonds. We'll have a little bit more to say on that. And so, here we're just extending and refining their paper. And our paper is on SSRN, and I've given you the URL there. Okay. And our main additional points to the Bessenbinder et al. Paper are, one, that due to heteroskedasticity, more powerful tests, indeed much more powerful tests, can be obtained by standardizing the bond returns. Right? The other is that due to this thin, infrequent trading, as I said, on an average day, more bonds don't trade than trade. Right? That due to this thin, infrequent trading, you can get more powerful tests by extending, by using price observations on several days before and several days after the event than just using the day before and the day after. Right? Now, our procedure, we're going to follow the procedure recommended by Bessenbinder et al. We're going to calculate for each bond, we're going to calculate the abnormal return as the bond return minus a benchmark, where the benchmark is a portfolio of bonds of the same rating and similar maturity. We're going to calculate for each firm, we're going to take all the bonds issued by that firm and average them together. And for now, we'll just do it equally weighted. We're going to propose standardization, but let me first show you what happens if you don't standardize, okay? Now, our procedure here, like all these methodology papers, is to test for type 1 and type 2 error with a Monte Carlo procedure. So we are going to choose to test for type 1 error, the likelihood of finding false evidence of an event when no event actually occurred. We're going to test for that by just choosing firms and days at random, right? Non-event days, sort of. Right? Then we're going to apply the test to this non-event sample. We're going to repeat this for a large number of samples, 10,000, right? And we're going to calculate how often the test inaccurately find evidence of an event when none in fact occurred. Right? Then we're going to go back and we're going to test the power of the test, the ability of the test to actually detect an event when it does occur by, again, choosing a sample of days and firms at random. We're going to induce an artificial event by bumping the returns 15 basis points, so like from 3%, 3.15%. Right, we're going to apply the test to this artificial sample. We're going to repeat that for a large number of samples and calculate how often the tests correctly find evidence of the event. Right. Our data here for this is going to be trace data from 2005 through 2011. We do a number of things to restrict the sample to your sort of standard bonds. We also do a number of filters to filter out weird trades. And by the way, Bill Maxwell has on his website, he's made available a SAS code for doing a good bit of this filtering, and we apply a few others. We wind up with about 5,500 bonds, about 1,600 firms, and about 15 million trades. Right? So, and we are, and what we do first is before choosing our sample, we just calculate 2-day returns. So for each day T, we calculate returns from the day before, from T minus 1 to T plus 1. Right? We calculate the bond return, we calculate benchmark returns for bonds of the same rating and similar maturities. Right? And we calculate the abnormal returns as the difference there. Right? Then we calculate firm day abnormal returns as an average of the bond returns. Right? And here are the basic results. And what I would point out to you are these. One, the standard deviation of these 2-day returns from T minus 1 to T plus 1 is about 1.5%. Another point I would point out is that there is extreme kurtosis, considerably more than you would normally find in stock market data. Right? And the final thing is, again, to calculate a return over 2 days, we have to have trades on both days. And that turns out to be possible for only about 38.6% of our days. So, just using, the techniques that we would normally use in the stock market is, you're going to miss a lot of possible days, right? Again, our Monte Carlo procedure is we're going to choose 300 event days at random. Now, not all of these, because we can only calculate, due to thin trading, because we can only calculate returns for over a 2-day period for about 39% of this. And on average, that works out to about 114 days. We apply our test, we repeat for 10,000 random samples, and we calculate test size. Right? Then we shift, we introduce an artificial event, and we test the power of the test to detect the event. And here's what we find. Right? First, here's our type 1 error. And we're using a 5% two-tailed test. So by chance, these are cases when there's really no event. Right? But we're looking at how often the test falsely says that there is an event. This ought to be around 2.5%. Right? And it is. All these should be around 2.5%, and they are. Right? more importantly, we want to look at the power of the test to detect this event that shifted returns by 15 basis points. And those are the results here. So this is how often the test actually detects the event. And what you see is that the t-test doesn't do very well. It only detects events about 20% of the time. Right? The sign rank test about 50% of the time, right? And the sign test about 60% of the time. Now, this is kind of what I would refer to as the best current practice. Right? We think it can be improved on. Right? And we think that the low power of particularly the t-test is likely due to this heteroskedasticity that I talked about, that returns on short maturity, high-rated notes are going to be much less volatile than the returns on on low-rated, long-maturity bonds. And actually, if we go back here, overall the t-test detects the event about 20% of the time. But that varies from close to 100% for short-term, high-rated securities to close to 0 for the longer ones. Right? So, as I said, the problem is that short-term bonds are a lot less volatile than long-term bonds. And sort of here's the data. Remember that the standard deviation of returns for the whole sample is about 1.5%. Right? But that varies from about 3%, right, for low-rated long-term bonds to about 0.4%. So when we're talking about, let's say, a 15 basis point event, that's a pretty sizable event versus this one, right? But it's minuscule versus this one, right? Okay, so here's our suggestion, right? Our suggestion is to correct for this by standardizing. Now this issue has a history. It has a history from the stock market literature. The first test used abnormal returns in cars. A number of people, particularly Patel, suggested standardizing the cars by a standard deviation and using SARs and SCARs. Right? And Brown and Warner found that that was more powerful. Now, it turns out that in most stock market studies, it makes very little difference, as illustrated by these two quotes. But it does make a lot of difference in the bond market. Right? So here's what we do. Right? We suggest standardizing each bond return by dividing the return by the standard deviation of returns, and we do it using returns from day t minus 50 to day t plus 50 around the event, not crossing the event. Right? Some of these standard deviations, you got bonds that don't change, so you get a standard deviation of 0 or close to 0, and if you divide by 0, you got infinity. So we Winsorize at the 1/2 of 1% level. And the main one I'm going to talk about here is we calculate what we refer to as abnormal standardized returns as the standardized raw return. We recalculate the benchmark and calculate as the standardized raw return minus the standardized benchmark. Okay. First, if we do this for all the data, before choosing our samples, we do it for all the data, a couple of things. One is, we still have excess kurtosis, but look how much it comes down. It is getting to be quite small. Another is, if we standardize, the standard deviation for individual bond raw returns is 1. We're dividing the return by standard deviation, so the standard deviation of standardized should be 1. This is a little bit smaller here, right? Because 1, we're subtracting off a benchmark, and that's taking out some of the noise. And then we're averaging together bonds, different bonds of the same firm, and that takes out more of the noise. So what difference does this make? Right? Again, the probability of type 1 error is okay. You know, here's unstandardized and here's standardized. The probability of type 1 error is okay. Right? The power increases substantially. Right? The power of the t-test to detect the event rises from around 20% to over 60%. Right? It also increases for the sign rank test here. Right? And so if you turn this around, if you subtract this from 1, you would get the likelihood of type 2 error. So the likelihood of type 2 error is cut about in half for the sign rank test. And it even goes up for the sign test. Now when you standardize a return, the sign doesn't change. So you might think, well, what the hell's going on here? Why does the power of the sign test go up? And it's because for individual bonds the sign doesn't change, but when we combine those into a firm return, we're getting different weights on the individual bonds. So some of the signs change. So the power increases substantially. Now, given these results, I mean, we've used a 15 basis point across the board event, and given this observation, you might think, well, is it reasonable to expect the event would impact short-term bonds and long-term bonds the same? And the answer is no. So, we do it for proportional events, but I'm just going to stick with the 15 basis point because it's more intuitive and simpler. Okay, let me look at some sampling and calculation issues here. And there are 3 basic issues I want to take up. What price observations, what trade observations to use in calculating the average bond price on day T. Right? Second, how to weight the different transactions in calculating the average bond price. Here we're going to, best reminder at all, recommend throwing out the very small trades. Right? And then third, how best to calculate firm returns from bond returns. Right? So those 3. Right? Let me get a drink of water here a second. As I said, because of the noise in small trades, Best and Binder in their paper, they recommend tossing out the very small trades. And the advantage of this is that small trades are going to have a lot more noise in them. Right? The disadvantage is you're going to lose observations. Right? So we do it both ways and look at the power, and we find that basically these 2 effects offset each other. That you're reducing the noise, but you're reducing the number of observations. It turns out basically to be a wash. Right? Another approach along the same lines is that since 2008, Trace tells you whether the trade was between dealers or between a dealer and a customer. And the spreads between dealer trades are going to be a lot smaller than the trades with customers. The bid-ask spreads are going to be a lot smaller. So again, if you restrict the sample to just dealer trades, you're going to get rid of a lot of the bid-ask bounce. You're going to get rid of a lot of that noise. But you're going to lose observations. So again, we do it both ways. We find that it makes little difference overall, but you get slightly more powerful tests by using them all, not excluding the non-dealer trades. Another issue is in once you got all these trades, how are we going to weight them in calculating the average trade price for the day? And they weight, the Best and Binder et al. Paper weights transaction prices by trade size. And we thought, well, maybe that's a little extreme, because a trade of 1,000 bonds gets 10 times the weight of a trade of 100 bonds. So maybe we ought to make the difference a little less. So we looked at using the square root of trade size, and it makes little difference. We got a little slightly more powerful results using the square root of trade size, but it's minor. Next issue, they weight unstandardized bond returns by the number of bonds outstanding to calculate firm bond returns. Right? Note that what we've done is we've used an unweighted average of standardized bond returns. And we think the advantage of this is that if you don't standardize, if you average without standardizing, your sample is going to be dominated by the most volatile bonds, the long-term, low-rated bonds. Right? Standardizing gives the less volatile bonds more weight when you average them. And we find that averaging using standardizing and then averaging yields considerably more powerful tests than not standardizing or averaging and then standardizing, and that further weighting by bonds outstanding or trade volume makes very little difference. Right? So those are some calculation issues. They all turn out to be not that important, but we looked at all of them. So let's go to the next one that is important. Right? Said a real problem here is that bonds are very thinly traded. I know, I've said it twice, so I'll say it a third time. On the average day, more bonds don't trade than trade. Right? So, so the 2-day returns are only calculable from day t-1 to day t+1 for about 37% of possible events that you might come up with for your event sample. So, so our suggestion is to expand the event window to include trades on several days before and several days after the event. Right? Now this has both advantages and disadvantages. Right? One, it increases the sample size because you're going to pick up some bonds that aren't traded on days t-1 and t+1. The other is that it averages out some of the noise, because if you got a bond that's just traded once on day t-1, and it's also traded on day t-2 and so forth, averaging those together averages out some of the noise. The disadvantage, of course, is that as you widen the event window, it's more and more likely that something other than the event causes the returns to change. So there's more noise in the longer ones. So, how does this balance out? Right? We consider expanding the event window, and I'm going to illustrate it for an event from day t-3 to day t+3, which we think is about right. And the way we do this is we calculate the abnormal standardized returns for all the possible windows within that period from t-3 to t+3. So, so we got a return from t-3 to t+1, from t-2 to t+1. And now keep in mind that there aren't going to be trades on all these, so we don't have all 9 normally. We just have a subset of them. We average them together. Right? Note that the standardized returns are going to be, that once we standardize, we're giving more weight to the observations that are closest to the event. So we're giving more weight to observations on t-1 and t+1 than the weight we're putting on the ones further away. Right? But we average these together. Now here Here's sort of the data if we do this. Oh, and let me go back. I'm going to call these composite abnormal standardized returns because they include, all the days from t minus 3 to t plus 3. And I'm going to switch from using parentheses to using braces here. Okay, now here's sort of the data. And here, these are not composite returns. These are just abnormal returns. And this is from t minus 1 to t plus 1 and t minus 2 to t plus 2. And if we do, and these are unstandardized, so the larger the event window, the more noise, so a higher standard deviation is what you would expect, and that's what we get, and that's bad. Right? But when we calculate these composite returns, since we're picking up more possible trading days, one thing that happens is the sample, the number of days around which we can calculate returns goes up. Right? The other is that since we have more observations, we're averaging out more of the noise, and for standardized returns, these standard deviations go down. So this one's bad, this one's good, this one's good. Right? Okay, so what happens? Right? Here's where we left off in the last chapter after standardizing. Right? These are our abnormal standardized returns from t minus 1 to t plus 1. Right? And these are the powers. This one had gone up from 20% to over 60%, and this one had gone up, and so forth. So this is sort of where we left off. Right? Now, using these composite returns, bringing in trade observations on several days before and several days after, right, the power to detect the events goes up a good bit more. Right? And here for the sign rank test and the sign test is now, over 90%. Well, I guess that one isn't, but is quite high. So if you look at it for the likelihood of type 2 error, we're cutting it down to, around 10% for these two. Right? So that's basically it, folks. To summarize, this is what looking at the likelihood of correctly detecting a 15 basis point event, this is sort of what I would like to call, or forgive me, as the existing state-of-the-art, best state-of-the-art here. And two main things. If we standardize and we extend the event window a little bit to include a few days before and a few days after, right, we can raise the power of the test to detect the event a lot. Right? And so this is following our suggested procedure. So our main points are, once again, that when working with the trace data, combining that with CRSP and COMPUSTAT requires some care, or you're going to wind up with an extremely small sample. The other is we recommend, I would say we second the recommendation of Bessenbinder et al. To calculate the abnormal returns on the bonds as the return minus the return on a portfolio of bonds of the same rating and similar maturity. Due to heteroskedasticity, considerably more powerful tests can be obtained by standardizing the bond returns before calculating SCARs and standardized abnormal returns. And that due to infrequent trading, more powerful tests can be obtained by using a few days before and a few days after, rather than just one day before and one day after, giving most weight to the observations that are closest in time to the event.